2025 has been an incredibly strong year, especially for AI and tech stocks. Markets are sitting at all-time highs and companies are reporting their strongest earnings growth in nearly 4 years. But ultimately, the big concern here is all about valuation. We're sitting at historically extreme levels, something we've been discussing a lot about on this channel for quite some time. And when we look at the S&P 500 on a forward P basis, you can see there is a lot of red flashing right across the board. So investors, they are starting to consider, are we sitting in an AI bubble or not? And to make things even more complicated, we're seeing these circular AI deals like OpenAI doing billion-dollar partnerships with companies that somehow funnel the money right back to them. So the big question is, big tech, big spending, but will there ultimately be a big return? And Michael Burry certainly doesn't think so. He's warning that companies like Oracle and Meta could be overstating their earnings around 20 to 30%. He calls it one of the more common accounting tricks of the modern era, understating depreciation by extending useful life of assets artificially, boosts earnings, one of the more common frauds of the modern era. And you can see he goes on to specifically highlight Oracle and Meta, both of which we will touch upon today, and says more details will be coming on November 25th. And just yesterday we saw SoftBank dump their entire Nvidia portfolio. We're talking around $6 billion, not in fact to take it as a gain and run away, but actually to put that money into OpenAI. And we're seeing this morning bullish news for AMD shareholders, where the CEO said yesterday they're expecting 35% annual growth over the next 3 to 5 years for what she says as insatiable demand for AI chips, and that they expect profit to triple by 2030 and the data center market to grow to $1 trillion. So today we're going to run through quite a large number of companies that are benefiting the most from AI. We're going to use our reverse DCF model to flag to you what exactly is baked in if you are buying one of these companies today. What is the free cash flow expectation, so you are able to see from your own view whether or not companies like Oracle are in fact truly undervalued or dangerously overpriced. And Oracle is the company we're kicking things off with. Over the last year, it's up 25%. Year to date, very strong, up 42%. But just look at the last month, this one has cooled down very significantly, down 24%. Over the last 10 years though, this is one for the time being that has massively outperformed the S&P, currently trading in the midpoint of the 52-week range. Now we get a hold from both C Alpha as well as Quant, although Wall Street do give this a respectable buy, 4.2 out of 5. And if we look at the forward P at 33, that is significantly above their 5-year average of 19.2. Not only does this give us a severe overvaluation signal, but remember, regular viewers will know we've covered this company many times in terms of one of those to consider as a hold, sell, or to take profits, because it wasn't that long ago it was trading at a forward P just below 50. And even when we take a look at the blue tunnel, which for newer viewers highlights the intrinsic or fair value, Oracle is a company that consistently over the last year, even during the Liberation Day drop, has been trading well above its fair price. And if we zoom out to the last 10 years, well, in fact, you can see this company did trade in a reasonable signal around 2023, but since then it has only gone on to get larger and larger in terms of disparity. So we would say, based solely on this, Oracle is looking severely overvalued. And just before we get into the DCF model, on a valuation grading, they're getting a D-. They trade at a forward P of 35, which is higher than the sector at 24, so you're paying a 44% premium. In terms of their own 5-year average, as we just pointed out, you are in fact paying a 64% premium. Now for these companies that we're running through today, you could argue the price to earnings growth may be more appropriate, and at 1.54 could be up for consideration, as we do typically say below 2 does make us want to dive a bit deeper, and the DCF will give us a good idea whether or not this is one to get excited about. Against the sector, they're trading on a price to earnings growth 12% discount, and even against their own historical 5-year average at a 22% one. Now our intrinsic value based on the discounted cash flow comes to $193 for Oracle, and you can see we've used a growth rate of 20%. As always, the numbers here are highly subjective. We have 15, 20, and 25, and you can grab a copy of this model by clicking on the pinned comment below. But using the middle rate of 20% with the discount rate, it does ultimately give us the present value of future free cash flow and terminal price, where we add together with the cash, subtract total debt, gives us the equity value, and dividing by the shares outstanding comes to 193, actually indicating double-digit negative 19% downside, something that if you wanted to be conservative at 15%, you can also see $133 downside of 44. Now, for those that are a lot more optimistic, if you do want to use a 25% growth rate moving forwards, 272 is the intrinsic value, which actually indicates 14% upside. Now, the key thing out of all of this that we really want to point out is that on a reverse DCF, so what is priced in if you are buying today at 238 is 23% growth to the free cash flow moving forwards. Now, that'll give you a good idea if you believe it can grow faster than undervalued, but if you believe this number is way too high, then stock number one, Oracle, does look overvalued. Now, we're not done there, because on our models we do like to use the middle rate, which today comes to 20%, to understand what is the margin of safety on offer. Now, already a giveaway, given the current price is above the intrinsic value, there is no margin of safety. In fact, you will notice a 23% premium is what investors are paying if you are adding today. Now, typically we like to use a minimum 10% MOS, where we execute buy if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today we'll buy at $174, and we can keep going if you want targets at 20%, buy at 154, and at 25, 145. Wall Street, with their respectable buy ratings, see this at $354 into next year, translating to 49% upside. So let us know your views. This is ultimately based on 20% growth rate. Maybe you believe no, it will be faster at 25, when in that case you are getting a margin of safety of 12%. And as we can see, Wall Street do believe nice upside is on the way. So stock number one, Oracle, where do you see it in terms of a buy, hold, or avoid? Do let us know. And before we continue, we want to let you know we have released our latest free weekly article covering 3 stocks to buy on the pullback we saw last week. Now we drop one every single Sunday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of November, lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is Nvidia, which is up 33% in the last year. Year to date up 44%. Over the last month, not too great, up only 2%, but over the longer term, shareholders who have held this for 10 years would be up more than 24,500%, significant outperformance of the S&P, and it is trading very near to its 52-week and all-time high of $212, where we get a strong buy rating from Wall Street, a weak buy rating from Seeking Alpha, and a hold from Quant. And in terms of the forward P, it sits at 34, which is below the 5-year average of 40. So unlike Oracle, with Nvidia, what we're seeing here is a potential undervaluation signal. And if we were to look at the blue tunnel, that also confirms the exact same thing. Actually, unlike Oracle, which spent the last year trading in a severely overvalued position, Nvidia, the complete opposite, has spent most of 2025 in an undervalued level, something we're also noticing today. And if we zoom out to the last 10 years, actually quite interesting, from around the beginning of 2024, even with the dramatic share price increase, this one has still looked to be trading in an undervalued level. Will be interesting to see what the DCF model does highlight. Now, valuation grading, they get an F as they're trading at a 77% premium to the sector on a forward P, 8% discount though to their own 5-year average, and looking very attractive if you solely look at the price to earnings growth, 1.3, 26% discount to the sector against their historical a double-digit 22% discount. And then if we get to the valuation, it comes to $179, again from the DCF model. Now you'll notice we've used a growth rate of 20%. The last 5 years and 10 years on average, they've been growing free cash flow at a triple-digit rate. Baked in today, we're seeing 21.4%, so that is why on the middle rate of 20%, we are in fact seeing downside of 8. Again, if you want to be more conservative for Nvidia at 15%, intrinsically 133 does mean 32% downside, and if you believe these numbers are way too conservative, well, at 25% growth, $240 does mean 23% upside. So using the middle rate then of 20%, that is where we ultimately get the margin of safety or premium on offer today, and it sits at a 9% premium, with Wall Street believing this will be higher into the next year at $240, translating to 23% upside. Now on Nvidia, if you wanted a 10% margin of safety, based on the growth rate we ran through, that is looking like a buy at 161, at 20% a buy at 143, and at 25, 134. Now if you disagree and believe these numbers are in fact too conservative, well, we'll flag using the 25% growth rate, you are in fact getting a 19% margin of safety, which puts it bang in line with where Wall Street see this over the next year, which is really telling, highlighting that Wall Street believe Nvidia can grow their future free cash flow at a rate of 25%. So for Nvidia, like Oracle, give us your views whether it's a buy, hold, or complete avoid. Then we move on to advanced micro devices, up 61% in the last year. Year to date, up 97%, nearly a double, will likely be given in the pre-market, it's up more than 6%. Over the last 10 years, similar to Nvidia, massive outperformance, up more than 10,000%, trading very near to 52-week and all-time high. Likely we may see this in the coming days if the strength we're seeing in the pre-market continues. Weak buy rating from C Alpha, hold from Quant with a very near 4.5, strong buy rating from Wall Street, and the grading at a C right now telling us you're paying a 150% premium to the sector, a 55% premium to their 5-year average, but on a PEG 1.5 looking good, 16% discount to the sector, but historically AMD has traded much lower at 1.18, meaning you're paying a 25% premium. Now our intrinsic value at $162, off the bat you may believe that is way too low, but we're using a growth rate of 20%. On a reverse DCF, it is one of the higher ones we're covering today at 28%. We'll tell you a lot about where you need to see this to truly believe it is in fact undervalued, because at 20%, $162 is downside of 35. Naturally, if you believe the same at the lower rate downside, and even the higher end we have here at 25%, we are talking downside again. On the extreme level though, at 30%, if you truly believe that is reasonable, $289, indicating 16% upside, and that is a little bit above where Wall Street see this over the next year at 278 with 11% upside. You can also see if you believe that extreme growth rate is true, is applicable, then a 14% MOS. But if we do move it to that medium rate for consistency at 20%, we are talking for AMD a 55% premium. Likewise, if we show you the 25% higher rate, maybe you believe that is actually what it should be, then a 15% premium is currently on offer. So let us know, AMD, where you believe this company does sit in the spectrum of buy, hold, or sell. And then we move on to Microsoft, up 22% in the last year. Year to date, up 21%. Over the last 10, very strong, 839%. Like all stocks today, a massive outperformance of the S&P on about a 10% pullback from their all-time and 52-week high at 555. Strong buy from Wall Street, a buy from Seek Alpha with a hold from Quant, and we notice a forward P30 is actually lower than their 5-year average of 32, so potentially undervaluation. And if we do look at the blue tunnel, firstly, one thing we haven't touched upon, always good to see it increasing over time. That is naturally what you want from a company, intrinsic fair value to gain momentum in the right direction, and we do see it right there towards the bottom end, indicating reasonable / slight undervaluation, during Liberation Day, you could have bought this in a clearly undervalued signal. And if we do zoom out to the last 10 years, well, you can clearly see this one very rarely enters into a severely undervalued level. So make sure you're subscribed, notification bell is on, we will flag it to you when opportunities are available. And then on the valuation grade, we get a D-. It's trading quite above the sector, so you are paying a 32% premium against their own 5-year average, as we highlighted, a little bit below. On the price to earnings growth, one of the least attractive so far at 2.4, 36% premium to the sector, not too dissimilar from their own 5-year average. And if we look at our intrinsic price at $502, you can see we've used a growth rate of 16% moving forward. Average is a little bit lower at 14. Most recent year was only an increase of 3%. On a reverse basis, we're talking 16.3. So using the middle rate of 16%, you are paying a premium, although very slightly, at 2%. Wall Street sees $635 into next year, 24% upside. So if we do use 10%, then a buy at 452, at 20%, a buy at 402, and 25, $377. Now you may disagree, again believe we're being way too conservative, but at the 18% upper end, you will notice $577, still significantly below Wall Street, indicating they're anticipating Microsoft to grow much faster than 18% over the longer term. And with that 18% on offer today is a 12% MOS, so let us know your views on Microsoft. We then move on to Google, up 62% in the last year, year to date up 54%, over the last 10 years up 650, trading right there at 52-week and all-time highs. Looking likely today they're going to break the new all-time high barrier, maybe even touch the $300 mark, where we get a strong buy from Wall Street, a buy from Seek Alpha, and a hold from Quant, and it's trading at a forward P now at 28, where when you look back it hasn't been this high since 2022, well above the 5-year average of 21.6. Straight away, severely overvaluation signal is in fact flashing, and we can see that is also confirmed when we look at the blue tunnel, although something only started from September. Otherwise, over the last year, you had a long time to buy this in an undervalued level. And zooming out to the last 10 years does tell you Google does typically give you a chance to buy this severely undervalued. So if you have patience, if you want a company like Google in your portfolio, and you believe that history, whilst it may not repeat, but does rhyme, this one could come back down into an undervaluation signal if in fact you do have patience. Now the grading does sit at an F, where against the sector you're paying a 77% premium, 17% premium to their 5-year average, and price to earnings growth 1.9, 28% premium to the sector. But look, this is one that also trades fairly low historically on a PEG, so 39% premium. And our intrinsic price comes to $229. You may believe this is way too low, but look, we've used a 12% growth rate. Average does sit high at 20, most recent year at 5%. Baked in today is 15.6, and you'll see double-digit downside unless you believe they can grow faster than in fact 14%. Even using the extreme version here of 16%, it comes to $302, marginal upside of 3%. And we also notice that is lower than what Wall Street see at 315 into next year, meaning they believe it will grow faster than 16% over the longer term. Now, using the middle rate of 12%, you will notice today you're paying a 28% premium. 10% MOS would be a buy at 206, at 20 a buy at 183, and 25 a buy at 172. We can go straight to the extreme version if you do believe that is more reasonable. At 16%, you will notice a margin of safety, but very minimal at 3%. So let us know where you sit on Google in terms of a buy, hold, or complete avoid. And then we move on to Meta Platforms, up 8% in the last year, year to date up 7%, but just in the last month, down 13%. Over the last 10 years, up nearly 500%, now trading towards the lower end of the 52-week range. Strong buy from Wall Street, hold from Quant, weak buy from Seeking Alpha, and we notice their forward P of 21 is below the 5-year average of 23, so potentially undervalued. And when we look at the blue tunnel, we can see it is slightly below the bottom end, or in fact sitting right at that point. Liberation Day was an undervalued level. Today or over the next few days, if it continues to come down, we could see this in a clear and obvious severely undervalued level. And zooming out over the last 10 years, we notice this one, in fact more than Google, trades a very long time in an undervalued level below its intrinsic price, something we haven't seen that clear that often going from 2023 onwards, but maybe this is what we will see if they continue to ramp up the capex spending, something that Wall Street is getting very nervous about. Now, an F on the valuation grade, but when we look at the price to earnings growth of 1.57, that is still above the sector at 7%, and actually they're not trading at a discount to their 5-year average, they're pretty much trading in line. And when we take a look at the intrinsic value, it sits around the $800 mark. Now, we've been very conservative using 12%, but on average it's grown 34%, most recent year at 23%, and baked in by a long margin, this one is sitting at the lowest on a reverse DCF at 8.6%. So whichever one you use today, which is very unlike the previous ones, double-digit growth is anticipated, 27% at this 12% level, around $798, which does give you a margin of safety at the lower end today of 22%. If you wanted 25, we'll buy around $600, and Wall Street see 845 into next year, 35% upside. If you believe we're being conservative, well, look, at 14%, you can in fact see you're getting a massive 32% MOS for Meta with an intrinsic price at 919. So give us your views on Meta platforms today. And then we move on to Broadcom, up 97% in the last year, 54% year to date. Over the last 10 years, up more than 2,600%, sitting right there at the upper end of the 52-week range. Strong buy from Wall Street, hold from Quant, weak buy from Seeking Alpha. And we notice the forward P, 42, well above the 5-year average of 19, one of the largest severe overvaluation signals we've seen today. And that's also confirmed at the blue tunnel. Massive disparity pretty much over the last 12 months between the share price and the upper end of the fair value. Something that when we zoom out to the last 10 years really started from 2023, something we've noticed with other stocks. Otherwise, Broadcom does typically trade in a reasonable signal. And a D- on the valuation grading, they're trading at a triple-digit premium to the sector, but also a triple-digit premium to their 5-year average. Price earnings growth at 1.8, pretty much in line with the sector, but also another premium to their 5-year at 22. And our intrinsic price at $259 is in fact using a 20% growth rate. Baked in is around the 25% level. 15 or 20, we're talking double-digit downside. And even if you believe no, they'll grow faster at 25%, well, look, the upside is very marginal. We're talking in the mid-single digit. So using the middle rate of 20%, you are obviously going to be paying a premium, quite large, at 37%. Well, Wall Street see this, bang on $400 into next year, 13% upside. So let us know your views, because ultimately, even with Broadcom, if you believe 25% is more reasonable, look, you are only getting a 3 to 4% MOS, but do give us your views. We then move on to Palantir, which is up 217% over the last year. Year to date, up 146%. Over the last 5 years, up more than 1,000%, sitting right there at the upper end of the 52-week range. But for the first time today, we get a triple hold right across the board, and you're not going to be surprised to see these valuation gradings. 997% premium to the sector, 90% premium to their 5-year average, and a price to earnings growth 6.63, 281% premium to the sector. But even if you want to look at other valuation metrics, some of them even we're seeing 4 times, 2,773% premium to the sector based on the price to sales. And you may believe, well, look, that it's in line with their average. Even that, we're seeing massive disparity. And our intrinsic value comes to $95, which is using a growth rate of 35%. Baked in is just under 47. So even if you believe they can grow at 40% over the longer term, the intrinsic price comes to 125. That is downside of 35, and still highlights you're paying a premium, a huge 54%. Even Wall Street don't see any upside over the next year. 185, that's downside of 4. And if we use the median rate of 35%, well, you're going to see a margin of safety of 0, a premium in the triple digit 102%. So let us know on Palantir. And then we move on to Amazon, which is up 20% in the last year, 14% year to date, 645 over the last 10, trading very near 52-week and all-time highs, just below $260. Strong buy from Wall Street, respectable buy from Seeking Alpha with a hold from Quant, and they're trading at a 113% premium to the sector, 79% discount to their 5-year. Price to earnings growth 1.85, little bit above 9% the sector, but looking good below our 2 criteria. Now our intrinsic value gets to $228, where we've used a growth rate of 20%. Baked in is 21.4, so using the extreme of 30%, there is upside, but that is very, very high for them to achieve over the longer term. That would give a price of $450. The 25% would give a price of $322, upside of 28. And if we look at Wall Street, their expectation is $300 into next year, 20% upside. So using our middle rate of 20%, you will in fact see $228, indicating today a 10% premium, maybe something you would consider for a company the quality of Amazon, but do let us know whether you see it now today as a buy, hold, or complete avoid. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.